Richemont, the owner of several of the world's leading companies in the field of luxury goods, eased fears that the sector might be in for a marked slowdown after it reported in January that third quarter sales rose 24% at constant currency prices to 2.62 billion euros from 2.11 billion euros a year earlier. Now, let's touch on Richemont, because in light of those results, we also saw the likes of Tiffany coming out saying that they had had a very tough Christmas trading season in the US. But it appears that the Cartier brand stands strong and that the Chinese are favorable buyers in this environment.
For sure, I think it follows through with the pattern we're seeing. The new Chinese millionaires looking to spend a lot of the growth that they've acquired over the last couple of years, and your very high-end brands like Cartier are doing extremely well, specifically coming out of Asia. So I think that the shining light for Richemont has definitely been Asia Pacific.
And Asia Pacific, 40% of the group's revenues come out of Asia Pacific. We've got about 15% exposure in Europe and 24% exposure in the US. Do you like that mix in revenue?
Apparently, it's all Chinese people. In Europe, it's Chinese people, because if you go to the Cartier boutique store on the Champs-Élysées, it's full of Chinese people. If you go to the airport in Dubai, the people at the Cartier shop there are also Chinese people. So, I mean, it seems that luxury goods industry is really one of the best ways to invest in the whole Chinese economic miracle. And because there are 1.3 billion Chinese, and because they all want to impress their friends by wearing luxury items, this is the ultimate bling market. In other words, this is like one of the biggest and most exciting kind of investment themes out there. Richemont is perfectly positioned because they're quite conservative. They're not as broadly spread as LVMH. So I do like the story, and I think
you own bucket loads of the stock, I presume.
It's true. So, you know, I have to concede the vested interest here in my comments.
Richemont yesterday, well, not Richemont, yesterday we saw China revising down their target growth to 7.5%. It's been at 8% for 8 years in a row. The market had a knee-jerk reaction to that. How did Richemont fare?
That's a good question, actually.
Since you own bucket loads
They've
of
been
it,
bouncing around between
Richemont
45,
fare?
46, so they were kind of relatively unaffected by the shift. Slightly lower, I think, in the last few hours, but that's because everything was downish.
In terms of valuation at 45 Rand?
Sure. I think whilst I understand the story, I do think on a PE of 21, and to get a bit of common sense to that number, we like to look at a through the cycle PE, and that's closer to 24. And it's not really heavy in terms of paying a dividend. So from my perspective, whilst I like the story, I think this is quite rich for my liking.
How do you respond to people like David Shapiro from Sasfin saying that this stock is never going to get cheap? You've got to buy in, otherwise you're going to miss the boat completely.
My thesis is that this isn't the only stock on the market. So I think there's other opportunities, better opportunities on the market to get good upside.
I want to just ask a question, Bronwyn, of Tshepo about the dividend, because those that own the stock know that you get a 35%, I think it is, withholding tax on the dividends because it's a Swiss company, and the Swiss take that off. Now, it's a problem because what they do is they send every single client a letter saying you can claim some of it back. But you have to go to SARS and you have to submit, you know, DNA samples and all that other kind of rubbish, and then send the forms to Computershare. And the problem is that even then you only get it after a big delay, and what you get is then a foreign dividend which is subject to local taxes. So we tell people to throw that stuff in the bin. But in effect, what you're doing is you're acknowledging that you're going to get a 35% reduction in your dividend. And the only kind of thing you can reconcile yourself about is that, well, I mean, the Swiss government's probably going to do something useful with it. So you can go there on holiday or something. But it is a concern because it does significantly reduce the dividend. And I don't know if that's a major concern.
Any concerns on that front?
Again, from my side, that would be a definite concern. Not much of a dividend payer because of that. And given the other valuations, I'd be staying away from this.
What would convince you to buy Richemont? Would this stock have to fall some 20-25% before you looked at it with interest?
Again, probably closer to a PE of 10 than a PE of 21. So yeah, from my perspective,
$20.
Paul is getting even grayer. I can see him under severe stress at the moment.
22 is high, but then again, this is a consistent performer. People love Johan Rupert. They love the fact that the stuff gets made by like Oompa Loompas in the mountains of Switzerland and then shipped around the world, and it's got all that cachet and it's fantastic margins. So I don't see it getting any cheaper. In
Tshepo,
fact,
you want to add in
I
here?
think it's going higher.
This is on a return on equity of 15 and a bit. Steinhoff is on a return on equity of 15 and a bit, and I can get Steinhoff on a PE of 9. So I'd rather be focused on that sort of exposure in my portfolio.
What do you say to that argument? Steinhoff is cheaper.
Yeah, but Steinhoff makes like cheap chipboard furniture in Poland, and like who wants to own that kind of?
I really hope that Marcus Jooste is not watching this show for your sake tonight. All right, we're not going there. I'm going straight to hot or not. Hot or not on Richemont.
Not hot at all.
Not hot. And it's burning hot in your...
As hot as a
in your-
Cartier tank watch, Bronwyn. I don't have to tell you how hot those things are.